I don't own a debit card. I've never owned one. I've never allowed my 3 sons to possess one. Certainly and truly the worst financial tool ever given to the American consumer. So a long time ago, I asked myself a simple question: how would I remove 99.9% of my personal liability like that?
Picture yourself at the end of the month facing a pile of bills waiting to be opened. As you scan through the amounts you owe, $700 for your car, $400 for your student loan, $100 for your credit card balance. Do you feel the mounting stress? Do you sense your fight or flight mode? These payments alone sum up to $1,200, and you haven't even factored in rent, groceries, utilities, insurance, or fuel for your car. Gradually, your stress transforms into fear, and you ask yourself, how on earth am I going to afford all this? You may be able to cover it all, but you'll be left with no funds for emergencies, retirement savings, or the eagerly anticipated beach vacation next summer. Inevitably, you may end up charging the vacation expenses to your credit card, further deepening your debt. In today's world, debt has become integral to our lives. Loans are readily available for almost anything, and even if you don't engage in formal borrowing, credit cards can easily trap you in debt. However, acquiring a loan means purchasing things beyond your current means and sacrificing your future income for immediate desires. The major setback with loans and credit cards lies in their daily costs, as it forces you to continuously work to repay what you owe, ultimately limiting your choices and freedom. Succumbing to this vicious loop can keep you an enslaved person forever. The credit card industry, history and structure. In the early 20th century, charge cards were the first plastic cards that allowed consumers to buy now and pay later. The first universal credit card was introduced by Diners Club in 1949. What perks did they offer? The card allowed traveling business people to charge for meals at various restaurants and can make the full payment each month. Despite the rising doubts about the credit card system's profits, other cards soon entered the market. From the 1960s to the 1980s, buoyed by congressional and judicial support by deregulation, Bank of America and rival network, the Interbank Card Association, became the 2 major credit card players, offering cards they would eventually brand as Visa and MasterCard, respectively. The credit card game changed radically in 1978, when in Marquette National Bank of Minneapolis versus First Omaha Service Corporation, the Supreme Court's ruling granted national banks the authority to apply interest based on the usury ceilings of the state where their headquarters were situated, rather than the home state of the customer. This decision prompted national banks to move to states with more lenient usury laws and led other states to repeal restrictive regulations to retain major financial institutions. During the late 19th and early 20th century, the credit card was widely considered an economic sin that inevitably led individuals into enslavement. It faced criticism for creating deceptive living standards. Industrialization redirected focus from production towards consumption through urbanization, increasing incomes and the availability of a wide range of new goods. In the early days, credit cards appealed to numerous individuals who used them for lifestyle purposes, with the majority promptly paying off their balances. This eventually led to the introduction of annual fees on cards in the 1970s. Over the following decades, technological advancements reshaped social interactions and gave rise to a new type of lifestyle user. As described by Juliet Scorer in her book, The Overspent American, the desire to imitate one's neighbor is no longer the primary aspiration for most modern Americans. Instead, they strive to achieve a quality of life characterized by materialistic acquisitions and conspicuous consumptions that mirror the lavish lifestyle portrayed by celebrities, television and film characters, and colleagues. The business of enslaving poor people. How credit cards became modern-day loan sharks. Today, an American adult, on average, has 3 credit cards with an average balance of over $5,500, while the credit card companies have hauled in over $176 billion in income in 2020 alone. Club Con Bank of America released the world's first general-purpose credit card in 1958, called the Bank of America card. Since there was no magnetic strip, it wasn't easy to track any purchases. Credit card fraud was remarkably easy back then, and unfortunately, Bank of America lost millions. But what they lost, they gained it back in triples. They started licensing it to other banks, then a merger in the 70s created Visa and the credit card. By the 80s, the competition was officially on. Most credit cards came with a magnetic strip, which opened up opportunities for more and more banks to start offering their customers credit cards. Who doesn't love free money? And people go insane over it. They were spending money that wasn't theirs. Along with other reasons, household debt in the U.S. was skyrocketing, and the business model worked perfectly. But there was still something missing: the profit. Initially, these credit cards only charged about 4 to 5% interest compared to today's average of over 16%. Banks made a modest amount of money from the interest they were charging. Mostly, they were legally barred from raising the interest rates. They were looking for a way to charge people more to turn this genius new tool into a loan sharking tool. They blindfolded people and made them believe they were buying stuff for free. Most states in the U.S. had lots of regulations that prevented credit card companies from raising interest rates. But then one state, South Dakota, eliminated its cap on credit interest. A few years later, the U.S. Supreme Court passed the Marquette decision allowing banks to export their interest rates to other states. This was incredibly important because it meant that if a bank was based in South Dakota and had an interest rate of 25%, it could charge the same percentage all over the U.S. regardless of the interest rate laws in other states. Effectively, the interest rate cap in the other states became meaningless. Suddenly, all the banks wanted to move to South Dakota because they could charge a lot more interest, and they started offering credit cards to everyone. College students, young adults, the unemployed, everybody gets a credit card, but you would just have to pay an incredibly high interest rate that would keep you trapped for life. Then the Supreme Court passed another bill called Smiley, which removed the last bits of regulation on fees and interest, and it gave banks free rein to start raking in as much money as they could. The results were 36 interest rates, or changing clients' interest rates at a moment's notice 36 interest rate. If you took 2 years to pay back a $10,000 credit balance, you would pay the bank over $14,000 and around $590 monthly. Most people can't even afford $600 a month and are trapped for much longer. Even people who would never miss a payment suddenly realized that their interest rate had tripled, and there was nothing they could do about it. By the 2000s, credit card usage had doubled, even in low-income households. After taking control of interest rates, their next target was getting new customers, and obviously, the client base they targeted was young college students. They wanted people who couldn't afford to pay off their debt, so their debt kept on getting bigger and bigger so they could reap a lump sum from them. You could get a credit card to build your credit score and take advantage of cashback bonuses and airline miles. That's something you often hear. Here's the truth about a credit card score. It's just an I love debt score. Your credit score is entirely based on how much debt you've taken on, and it has nothing to do with how wealthy you are or how good you manage your finances. It's believed that buy now, pay later programs are a great way to purchase items you want without waiting or spending time saving money. But they're a great way to drone yourself into high interest payments. For many of us, buy now, pay later turns into buy now, don't pay later. There's a widespread notion that you can't go to college without a student loan. But did the millionaires do that? Most millionaires have never taken out a dime of student loan debt. If you're vigilant enough, you'll probably hear someone talk about how student loans are a huge burden for many Americans. And they're exactly right. The student loan program in the U.S. is a disaster, and it's reached crisis territory. Anyone can go to college without a student loan. Yeah, you heard it right. No matter your economic background, if you choose an affordable school, apply for lots of scholarships, and get a job to start saving money, you can graduate debt-free. That's what most millionaires do. That's a big part of how they became millionaires. Debt stinks, doesn't it? We couldn't agree more. Let's face the facts together. Debt is not a secret weapon for building wealth. It won't magically grant you everything you desire in the blink of an eye. And here's the kicker. You can live without it. So let's dive into the world of financial freedom and explore how escaping the clutches of debt opens up a world of possibilities for you. Stay tuned for more exciting videos.